The initial point to note is the infrequency of global recessions. While recessions in individual nations or economic blocs like the EU occur somewhat regularly, a worldwide recession is an anomaly. Typically, when a significant group faces a downturn, another entity is advancing. For instance, back in the 70s, if Germany experienced a recession, somehow the US managed to navigate through it, despite encountering 3 recessions between 1974 and 1982. Nonetheless, a worldwide recession is an uncommon occurrence. We witnessed one during the 2008 financial crisis, although Australia managed to withstand it. Similarly, during the pandemic lockdowns in 2020s, global GDP declined. But such instances are uncommon. Normally, it's a case where one group faces minor issues, while another powers through and might even help the country or group experiencing the recession. Moving on to the United States, there was a mild recession in the first half of 2022. It was almost imperceptible. If you blinked, you might have missed it. The GDP for the first quarter was slightly negative at about 1.6%, and the second quarter wasn't much better, at approximately 0.9%. Therefore, for the first half, there was a negative GDP. A recession is generally defined as 2 consecutive quarters of declining GDP, and this fits that description. It's evident in the data. However, it was mild in nature, with the GDP rebounding in the third and fourth quarters. But I'm referring to a much more severe recession, one that comes with significant challenges and a sharper decline in economic output starting around this period. This downturn will include rising unemployment, a slowdown in industrial output and retail sales, and notably for investors, a steep decline in inflation. This raises a perplexing issue about the U.S. stock market. While it might seem clear-cut to some, the market operates under its unique dynamic. The prevalent belief is that if the Federal Reserve raises rates as I've outlined, causing a recession, they'll subsequently have to reduce rates. This is termed the pivot. The Fed pivot and lower rates are perceived as favorable for tech stocks and stock investments. However, what if inflation decreases more rapidly than the Fed anticipates? I believe it might. In such a scenario, if inflation drops considerably, and they achieve the target rate earlier than expected, does that imply they'll need to decrease rates? Possibly, but what's advantageous for stocks in that situation? If that occurs, people might simply say, inflation may drop and interest rates may drop, so buy stocks. However, if that happens, it's because we're facing a very severe recession, precisely what I'm predicting. Consequently, stocks could plummet by 30, 40, or even 50%. Or if you're predicting lower rates, comprehend the implications. It doesn't signify the Fed shying away from their responsibilities. It doesn't mean life is wonderful and that investing in tech stocks is wise. It signals the onset of the severe recession I've detailed, and therefore, stocks will plummet. Be cautious about what you wish for, as the saying goes. My forecast indicates that the Fed will indeed raise rates, over-tighten, and consequently induce a very severe recession. If they do adjust their approach at that point, it won't be for positive reasons. It will be due to dire circumstances, signifying the onset of a recession and a significant plunge in stock prices. Hence, don't buy into the Wall Street chatter regarding this matter, as I am certain the Fed will over-tighten. Regarding the Fed's lack of awareness, it's because they habitually lack prescience. They possess the most dismal forecasting record of any institution I can recall. Their entire history since 1913 has been fraught with one misjudgment after another. This would merely be another addition to their long list of errors. To sum up the Fed's stance, we know precisely what it is because they've explicitly conveyed it. All one needs to do is heed their statements. They intend to raise rates, allowing high rates to perform their function, observe inflation subside, and perhaps cut rates by 2024. My projection is that they will indeed raise rates, as I've delineated for the upcoming meetings. However, they'll over-tighten. There are already indicators of an impending recession, but the Fed isn't acknowledging them. I'll elaborate on these indicators later. Consequently, we're headed for a severe recession due to multiple reasons, resulting in a significant decline in stock prices. Hence, if the Fed does decide to reduce rates, don't rejoice excessively, because it will occur in a scenario where a severe recession, elevated unemployment, and plummeting stock prices are the norm. Now, let's address the global liquidity crisis. People might wonder if it's akin to a global recession. No, a recession or a depression differs significantly from a liquidity crisis or financial panic. These are distinct phenomena that can occur independently. In 2008, we experienced both a recession or depression and a financial panic coinciding. However, they can unfold separately. What's on the horizon seems to be a global financial crisis and a global recession materializing concurrently, sooner rather than later. You might ask, why do I mention a global dollar shortage? Some might counter saying, but didn't the Fed print $9 trillion in 2020s? Although the figure has decreased since then, the fact remains that a considerable amount was printed. How then can there be a shortage of global dollars? The part that people might not grasp is what lies behind the scenes, off the balance sheet. It's crucial to delve into the footnotes and fully comprehend what's being communicated. Presently, there exist $1 quadrillion in derivatives. For those unfamiliar with the term, 1 quadrillion is equivalent to 1,000 trillion. So, although the Fed printed $9 trillion, or perhaps it's now down to $7 trillion, the reality remains that there's a colossal $1,000 trillion worth of derivatives that need backing. Not all of it, not even 10%, but merely around 1% or 2% is adequate. However, during a liquidity crisis, banks become exceedingly selective about the collateral they'll accept to support this inverted pyramid of derivatives valued at $1 quadrillion. Presently, banks are adamant about their preferences, and this evolves over time, progressively worsening. It doesn't transpire overnight. It can become acute overnight, but it generally unfolds over a year or more. Currently, banks are expressing their unwillingness to accept corporate bonds or mortgages as collateral. They're not even inclined to consider 10-year Treasury notes. Their sole preference is for short-term U.S. Treasury bills. These Treasury bills have a maximum maturity of 1 year and 36 days, with options for 4-week bills, 8-week bills, 6-month bills, and so on. They represent the optimal form of collateral, being the most liquid, easily tradable, exhibiting low volatility, and being easily replaceable. Banks exclusively seek these Treasury bills. However, if you're a foreign bank, you require dollars to acquire this dollar-denominated collateral. This is why the U.S. dollar remains robust. Some might question this phenomenon, given the multi-trillion-dollar annual budget deficit, massive trade deficit, a debt-to-GDP ratio of 132%, and $31 trillion in debt. The answer lies in the demand for dollars in the international foreign exchange markets. The primary driver behind the dollar's demand is the necessity to obtain dollars for purchasing dollar-denominated collateral, specifically Treasury bills required to serve as collateral. This situation will persist until this system inevitably collapses, a process that's already in motion